This is the WellSource Partners October 31 Flex Beta Portfolio Structure Update, where we're going to be focused on the red money part of the portfolio. To repeat what that means, if you do risk profile and you get a 60 bonds, 40 stock allocation for a client, all we're talking about now is the 40% that's in long-term investments, the more volatile investments. So we have a core portfolio and satellite structure. So the core portfolio, which tends to be more buy and hold, it may utilize mutual funds. It could use individual stocks that are focused on high dividend stocks, or a custom wealth managed portfolio for taxable accounts where there's a little bit less turnover. For this review, we actually look at the WellSource Partners Focus 20 portfolio, 20 individual stocks making up about 40%, as well as 2 sector concentrations, 2 sleeves of about 10% each, along with the Wise Diversification sleeves, 4 sleeves of about 10% each. So in the Focus 20 portfolio for IRAs or qualified plans, it's about 60% tactical and a 40% core portfolio. Tactical sector overweight now includes an overweight toward the technology sector. So looking at why we have that, part of the reason is because technology is working better than the other sectors. The other major sectors that we look at in this sleeve represent parts of the domestic U.S. stock market that do best at different points in the cycle. So technology tends to do best mid-cycle, which is where we probably are right now. Energy often does better later in the cycle when you have a little bit of inflation. Financials are often early off the bottom, so they're early cycle performers, whereas healthcare, or another time you might use utilities, tend to be a little bit more defensive and do better in a recession. But when we look at what's working best in today's market, technology is working best, and that is one of our current overweights. From the bottom up, the research indicators on the screen talk about information technology is the favorite sector, followed by industrials and financials and healthcare. This is Luthold Whedon research, where they're focused on specific industry groups, a little more bottom-up focus. They also have some momentum, but information technology, you see some investable categories there, and about 8 of the 14 information technology groups are actually attractively weighted, doing well. We look at a few tactical indicators then as to whether or not to be fully invested. The first is Dorsey Wright, which does a lot of technical analysis, and when they look at the semiconductor sector, it's in a confirmed bull market. The software sector is a bull market in correction. In either case, Dorsey Wright would say that the technology sector is in a bull market, so no reason to have any of that money on the sidelines. Our second tactical indicator is the Luthold Whedon Market Trend Index, which is currently reading 63. Its neutral point is 50. It represents a balanced portfolio which has a minimum 30% equity weighting. The MTI would have to be around 42 or 43 before we would think about taking some money off the sidelines. In the second sector, we currently have from most clients the Fidelity Chemical Sector Fund, mutual fund. Once we moved off the Fidelity platform, that fund is no longer no transaction fee. And so if I were putting money to work today, I would use FIDU, the Fidelity Industrial ETF, which is maybe a little more cost effective getting out. We have the top weighted group, information technology, already. So in this case, we're making sure we've got the second group, industrial group, represented in the portfolio. We would apply a tactical indicator. Dorsey Wright follows the machinery index, and in their view, it's in a confirmed bull market, so no reason to have cash there. And our second cash trigger would be what our Raymond James strategist, Jeffrey Sowett, is thinking about the market. He is cautious from a trading perspective, has been since mid-September, but this is a little bit more of a long-term secular view. He's very bullish and secular, so we're fully invested. Next, we look at portfolio optimization through the capital asset pricing model and expected returns, where our key source actually is just what's available from the BlackRock Investment Institute, the expected returns from several different asset classes, most of which can be represented by iShares. What we're looking for in the optimization curve, it would be asset classes that sort of are bumpy or stick out to the northwest or upper left of this chart. Something like emerging market equity we have, it's not as much of a node now as it was in January when we bought it, but it's still showing among the highest expected returns, but it does show a lot of volatility in EM or emerging market equities. We also own high yield bonds from this same strategy, which tends to rebalance just every 6 months, but high yield is a relatively high expected return, 3 3/4%, say, for its given level of volatility. Where you don't want to be is the southeast or lower right part, for example, long-term treasuries, which have negative expected returns for volatility that almost matches the U.S. large cap stock sector. So our optimization investments include high yield bonds, typically a mutual fund that trades no transaction free, so we can get cash in and out easily, as well as an exchange traded fund that focuses on emerging market stocks. The next area we're going to look at is global markets. Where do we go for diversification outside of the U.S.? And we're going to start with, well, what's working in the market. In this case, when we look at what's working currently, it's Latin America. You'll see we have a lot of variety. Some of these exchange traded funds are hedging currency exposure, some are not hedged. There's large cap represented, there's small cap, there's different parts of the globe, and there's different parts of the economy. There's manufacturing companies, there's consumer companies, and there are materials companies, all represented. But what's doing best has been investments in Latin America, which are more basic materials focused, and so we're well positioned in Latin America and have been for a while. We'll also look at a tactical indicator for international. Here, the world markets are in a confirmed bull market according to Dorsey, Wright and Associates. And the other thing we'll do is take a look at what's working best, in this case Latin America, and make sure it's in an uptrend. Is it trading above its 200-day moving average as opposed to trading down and trading through it? In this case, it's trading above it. So we're fully weighted there. There's an opportunity to take this lead down to all cash if we're in a bad market as well. Now, asset class, the last tranche we're going to look at. Here we are currently in commodities through a Guggenheim Natural Resource Exchange Traded Fund. As you can see, it's slipping. It was top of the chart September 30th, but right now U.S. small cap growth is doing better, and a broad emerging markets ETF is doing better. So commodities are having a tough time retaining their place in the portfolio, and so when we come to month end, might have to make a change there. Real estate, another broad asset class, is lagging, as are developed markets generally. We're going to take a look at commodities, which are in the top part of the portfolio, and we're going to ask ourselves, are they in an uptrend, and use the 200-day moving average to evaluate that. They are above the 200-day moving average. If they weren't, if they were the best of a miserable lot and everything was going down, we would look at using cash instead, or perhaps long bonds as a hedge. Again, we would look at what's working in the market. The 200-day moving average on long bonds, it's just trading on either side. Technically, you could say it was below, so rather than owning long bonds today, we would own cash. So in summary, we are 100% fully invested because all of our technical indicators suggest the market is behaving. Right now we have 0% on the sidelines, and we're allocated along the lines of what you see here. If you do have any questions, let me know. Douglas May at 970-263-5126.